Hello and welcome to this week's economic update. My name is Lindy and today is 8/24/23. Let's go ahead and get started with the Fed notes from the meeting, from July's meeting. So a quote from Fed Chair Jerome Powell says, inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Remember, the Fed has a goal of getting inflation to 2%. It's their arbitrary 2% number. The Fed indicated it will not pivot from rate hikes to rate cuts until sometime in 2024. Fed members no longer believe the U.S. economy will enter a recession. Not sure I agree with that. Fed statements were very neutral, knowing that we've got 7 weeks of data to come out before the next meeting, and the next Fed meeting is September 30th. On the front of new construction, our supply is still not keeping up with demand. So if you take a look at both permits, or all three, permits, starts, and completions, you will notice that permits were up just slightly from last month, 0.1%, but still down 13% from last year. Starts were up 3.9%. From last month, up 5.9% year over year, and completions were down 11.8% from last month, and overall down 5.4% from last year. You will notice that the household formations is equaling around 1.5 million, yet starts and completions are well under that number. So again, supply is not keeping up with demand. On the existing home front, the opposite of new construction, right? July existing home sales down 2.2% from last month to 4 million annualized. This is down over 16% from last year. And remember, this is still roughly half the level we saw in 2019, which is why we're having such a struggle with inventory, right? So not much has changed on the inventory front from last month, pretty much the same. Inventory increased slightly to 1.1 million. I think it was 1.08 million last month. 3.3 month supply of homes, that didn't change. Normal is 4.6, so clearly we are low inventory, right? Days on market increased slightly from 18 to 20 days, and 74% sold in less than 30 days, which was down from 76%. So again, not much changed. Heard on the streets for the week, the full impact of the Fed rate hike has not been fully felt, is being said by many. The leading economic indicator, the LEI, fell 0.4% in July. That's the 16th month in a row of contraction. The LEI, the leading economic indicator, continues to project a short and shallow recession end of this year into first of next year. The Fed is projecting an unemployment rate of 4.1%, which is higher than the 3.6 reported. So obviously they think unemployment is going up. And then despite persistent inflation and rising interest rates, investors have piled into stocks so far in 2023 as concerns over a hard landing for the U.S. economy have dissipated. Rates were still up last month, which again is a little contrary to what it feels like they should be doing. So they went from 7.16 on a conventional 30-year. They went from 7.16 to 7.31, kind of a big jump in 1 week if you take a look at the recent history. A quote from the NBA chief economist says that Treasury yields continue to spike last week as markets grapple with illiquidity and concerns that the resilient economy will keep inflation stubbornly high. This spike pushed mortgage rates higher last week, with the 30-year fixed rate increasing to 7.31%, the highest level since December of 2000. So again, it feels like we should start to see a turn in the rates, and we thought we had, a month or so ago, and it's really just not heading that direction, is it? The DSCR 30-year fixed rates don't seem to be impacted quite yet by this, so they still are on pace between 7 and 10%, depending on your credit, loan to value, and your DSCR calculation. You guys have a great week. If there's anything I can help you with, any of your investor financing, you just let me know. Thank you. Bye.